Welcome to Talk Tickers, where we do deep dives into corporate earnings calls to help you, the retail investor, figure out what is actually going on.
Right, because reading these Wall Street transcripts can be, a bit like reading another language.
Oh, completely. It's just Wall Street jargon everywhere. But today we have a really fascinating one. We are digging into VF Corporation, or VFC.
The massive conglomerate behind Vans, the North Face, Timberland, Ultra, but basically a huge chunk of your closet.
Yeah, exactly. And we're looking specifically at their Q4 2026 earnings call. And our mission today is to cut through all that corporate speak and translate the actual numbers into, a plain language narrative.
Right, because this is quite the turnaround story. I mean, if you rewind to 2024, VSC was essentially fighting for survival.
Oh, they were on life support.
Totally. They were suffocating under this mountain of debt, drowning in bloated, slow-moving inventory, and the cultural relevance of their flagship brands, especially Vans, was just actively bleeding out.
It was a disaster. If you looked at the balance sheet 2 years ago, it was the picture of a legacy giant that had completely lost its footing. But, fast forward 24 months to this earnings call, and the narrative has violently shifted.
It really has. I mean, we're talking about a company that is now inciting actual physical fights outside retail stores over new sneaker drops.
Which is wild.
Yeah. And they've somehow taken this clunky legacy supply chain and algorithmically hacked it to operate at the speed of a tech startup.
And they're using localized AI pricing models to surgically manage gross margins. It's a massive shift. So we're going to break down the headline numbers, the story behind those numbers, what management is guiding for the future, and finally, the bottom line. Is this a bullish or bearish signal for you?
Right. And it's just such a fascinating structural pivot because in global fashion, you have this tension between two completely different disciplines.
Right. It's the creative versus the operational.
Exactly. On one side, you have the raw, unpredictable chaos of cultural relevance, like what teenagers actually want to wear. And on the other side, you have the unforgiving mathematics of global supply chains and corporate finance.
And usually companies are really good at one of those, right?
Yeah, almost always. But this Q4 call suggests VFC might actually be figuring out how to synchronize both.
So let's start with those headline numbers, because management announced a milestone on this call that you cannot ignore. For the first time in 3 years, VFC has returned to top-line sales growth.
That's a huge deal for them.
It is. So Q4 revenue was up 3%, which beat Wall Street's expectations. And if you zoom in on their largest region, the Americas, growth actually accelerated to 10% in the quarter.
Wow.
Yeah. And for the full fiscal year of 2026, revenue was up 1%. Now, I know to the average person listening, 1% annual growth sounds like a rounding error.
Right. It doesn't sound like a victory lap.
Exactly. But in the context of where this specific company was, that 1% is a massive structural indicator.
You really have to contextualize the posture of the company to understand that 1%. Because, like we said, 2 years ago in fiscal 24, VFC was in this totally defensive crouch.
They were just trying to survive.
Yeah, hyper-focused on liquidity. When your leverage is ballooning and cash flow is tight, you aren't playing to win market share. You're playing to not go bankrupt. In FY24, only 43% of their entire brand portfolio was actually growing.
So more than half the business was actively shrinking.
Exactly. But if you look at the data from the end of fiscal 26, 70% of their business is now growing.
That's a huge swing.
It's massive. Moving from 43% to 70% participation in growth, that tells you the fundamental posture of the enterprise has shifted. They've gone from survival mode to strategic offense.
I do have to push back a little on the enthusiasm around these top-line numbers, though.
Okay, play devil's advocate.
Well, think about a corporate turnaround like rewriting a massive buggy software code base. Fixing the back end so the site doesn't crash is great. Avoiding a 404 error is necessary. Okay. But just because the site is live again doesn't mean users actually care about the new features. So are these genuine signs of consumer demand, or are they just comping against quarters that were so historically catastrophic that literally any movement looks like a surge?
You're talking about the dead cat bounce.
Exactly. Is this just a dead cat bounce?
It's a highly prevalent phenomenon in retail turnarounds, and it is a totally necessary skeptical lens to bring to this analysis. When a company cleans out all its distressed inventory and resets the baseline, the initial year-over-year comparisons always look artificially robust.
Because the bar is basically on the floor.
Right. But what the CEO, Bracken Darrell, and his team laid out on this call suggests we are looking at something deeper than just a math anomaly. It isn't just the aggregate sales volume. It's the specific composition of those sales, the channels they are flowing through, and frankly, the speed at which the organization is reacting.
The tone of the leadership team definitely reflected that confidence. Bracken Darrell was taking this call from Vans headquarters out in California, and it was 5:00 a.m. local time for him, but he opened by saying it felt like a sunny quarter.
That's a very specific vibe.
It is. There's a distinct difference between a management team apologizing for the macro environment and a team that is just eager to walk analysts through their operational wins. But, we can't just look at the aggregate 1% growth. VFC is a portfolio company.
Right. Not all engines on the plane are providing the same thrust.
Exactly. So let's look at the specific brands doing the heavy lifting, starting with the absolute powerhouse of the group right now, which is the North Face.
So the North Face is just operating in a league of its own within this portfolio right now. They delivered 7% global growth in Q4, but in the Americas, they were up an astonishing 16%.
16% for a heritage brand is wild.
It really is. And what's structurally vital here is that this growth isn't isolated to a single season or a single legacy item, like, those classic puffer jackets. Their footwear division just posted its 5th consecutive quarter of double-digit growth.
5 quarters of double-digit growth in footwear. For a brand that most people primarily associate with fleece and outerwear, that is a massive category expansion.
And they paired these financial results with a major strategic announcement. They secured a multi-year partnership to sponsor the U.S. ski and snowboard team through the 2034 Winter Olympics.
I want to unpack the mechanics of a sponsorship like that, because to a retail investor, it might just sound like marketing fluff. But it isn't just about putting a logo on a TV screen. It's a highly calculated play for pricing power.
That is the exact mechanism at work. In portfolio theory, the North Face is VFC's established cash cow. But the danger for any cash cow is brand dilution becoming so ubiquitous that you lose your premium positioning.
Right. You become the brand everyone's dad wears, and suddenly teenagers won't pay top dollar for it.
Exactly. So by signing a decade-long deal to outfit Olympic athletes, they are aggressively anchoring the brand in elite performance credibility. In the apparel industry, we call this the halo effect.
The halo effect, yeah.
You spend millions developing highly technical, specialized gear for a few dozen elite athletes. And the margins on that specific gear might be terrible or even non-existent.
Right, because you're custom building it for an Olympian.
But the cultural authority you gain from that elite association cascades down through the entire product line. It allows you to sell a basic fleece jacket to a college student at a 30% premium, because that fleece carries the halo of Olympic-level mountaineering.
But let's look at the actual street-level reality of that demand, because the Gorp Core trend, which is this whole movement of wearing hyper-utilitarian outdoor survival gear as everyday city fashion, that has been a massive tailwind for the North Face.
Oh, absolutely.
You walk around New York or London and you see people wearing summit-level technical shells to go get a cold brew. But from an investment perspective, how vulnerable is this growth to the whims of fashion? If the streetwear crowd suddenly decides that outdoor gear isn't cool anymore, does this 16% America's growth just evaporate?
Well, it's the inherent risk of capturing the lifestyle consumer. Fashion cycles are ruthless. But this is precisely why that Olympic sponsorship and the focus on technical footwear are so critical.
It creates a baseline.
Exactly. If your entire growth thesis relies on teenagers thinking your logo is trendy, your revenue is fragile. But if you maintain absolute dominance in the authentic technical core of the market, the people actually climbing mountains and skiing backcountry, you build a floor under the brand.
The streetwear consumer respects the brand because the mountaineer relies on it.
Exactly.
Yeah.
Furthermore, the broad-based nature of the growth across soft shells, fleece, and footwear indicates they aren't relying on a single trendy silhouette. They're capturing market share across multiple functional categories.
It's a textbook execution of balancing heritage with modern lifestyle demand. Okay, so let's look at another heritage brand in the portfolio, which is Timberland. They grew 2% in Q4.
Not the explosive numbers of the North Face.
No, but it represents their 6th consecutive quarter of steady growth. And more importantly, their direct-to-consumer channel, their DTC, was up 8%. The narrative around Timberland seems to be about expanding the aperture of the brand beyond just the iconic 6-inch yellow boot.
The 6-inch premium boot is a cultural monolith. It's one of the most recognizable pieces of footwear in the world. But you cannot run a modern, high-growth global brand on a single, weather-dependent silhouette.
Right, nobody is buying the heavy boots in July.
Exactly. So the strategic imperative for Timberland has been to leverage the cultural weight of that boot to sell other things. Management highlighted their push into boat shoes, which they noted are seeing strong growth across all regions.
Boat shoes represent a completely different wearing occasion.
A different season, a different consumer mindset, all under the same brand umbrella.
They're also executing a major apparel reset starting this fall. They want to move away from just being the brand on your feet to offering a complete head-to-toe expression. And from a unit economic standpoint, this makes perfect sense.
Break that down.
Well, if you spend the marketing dollars to acquire a customer and get them into a Timberland store or onto the website to buy a $200 pair of boots, your customer acquisition cost is fixed.
Right.
If you can convince that same customer to add a $150 jacket and an $80 pair of pants to their cart that match the boots, your basket size doubles, but your acquisition cost stays exactly the same. That drops straight to the operating margin.
It is the holy grail of retail metrics increasing the units per transaction and the average order value. And there are qualitative indicators that this brand repositioning is resonating.
Like the award they just won.
Yeah, Timberland recently won the Fashion Maverick Award of the Year at the American Image Awards. That kind of industry recognition, combined with the rollout of highly productive, full-price retail stores, suggests the brand is regaining its footing as a holistic lifestyle player, not just a winter footwear utility.
So we have the Mountain Dominator in the North Face and the steady expanding heritage play in Timberland. But the most shocking number on this entire earnings call belongs to a brand that a lot of casual observers might not even know VFC owns.
Oh, interesting.
Antra. They posted 45% growth in the fourth quarter.
A 45% growth rate for a physical goods company in this macroeconomic environment is just staggering.
It's unheard of right now.
They surpassed $270 million in revenue for the fiscal year, achieving over 30% annual growth. And this marks their fifth consecutive quarter of double-digit expansion.
For context for you listening, Altra is a highly specialized running shoe brand. They are known for a foot-shaped toe box and zero-drop cushioning, which means your heel and the ball of your foot are the exact same distance from the ground. They highlighted specific franchises on the call, like the Lone Peak 9 and the Experience. But why is VFC, a company historically rooted in skate culture and outdoor apparel, pouring so much focus into a niche running shoe?
Because of the TAM, the total addressable market.
Right.
The global running shoe market is an absolute behemoth. It dwarfs the skate shoe market.
Right.
And management was very transparent that brand awareness for Altra is still exceptionally low outside a hardcore trail runner.
There's a ton of runway.
Exactly.
Yeah.
In the investment world, low brand awareness paired with a massive addressable market and a highly differentiated product equates to a very high ceiling. VFC believes this can scale into $1 billion plus brand.
Which is why they're heavily investing in it.
They are aggressively allocating capital into Altra's product creation and top-of-funnel marketing because the return on invested capital right now is exponential. They need a high-growth sprinter in the portfolio to complement the mature cash cows.
Okay, so we've celebrated the high flyers. But if you are doing a serious analysis of VF Corporation, you cannot hide behind the 45% growth of a $270 million running shoe brand.
No, you definitely can.
You have to address the elephant in the room. You have to look at the biggest, historically most important brand in their portfolio, the brand that essentially drove the entire stock price for a decade and then seemingly fell off a cliff.
We have to talk about Vans.
We have to talk about Vans, the skate brand that transcended its niche to become a global lifestyle juggernaut, only to lose its cultural heat and drag the entire corporate entity down with it. If you look purely at the consolidated global number for Vans in Q4, it is ugly.
Yeah, they were down 5% globally.
Continuing a painful multi-year slump. But management spent a massive portion of this call demanding that analysts look beneath that global number. And the specific data point they pointed to was this. Vans America's DTC, direct-to-consumer, grew 5% in Q4.
That 5% growth in the America DTC channel is arguably the most critical leading indicator in this entire earnings report.
Really? More than the North Face numbers?
In a turnaround situation, yes.
Yeah.
Because consolidated global numbers are almost always the last thing to turn positive. You have to look for the localized green shoots.
We need to dissect the mechanics of why that specific slice of the business matters so much. Because in Q3, they reported that America's e-commerce grew 4%. Now in Q4, the total America DTC, which combines e-commerce with their physical owned retail stores, grew 5%. Why is the market treating a 5% bump in one channel as proof of life for a multi-billion-dollar brand?
Because of the structural differences between direct-to-consumer and wholesale channels, DTC is the ultimate harbinger of real-time consumer demand. Well, when VFC sells a shoe through their own website or their own physical store, they have absolute control over the environment. They control the pricing, the visual merchandising, the marketing narrative, and the direct relationship with the customer.
And the Americas is their biggest market.
Right. The Americas region represents over 50% of the total global business for Vans. It's the heartland. If you can generate organic, full-price demand in your own stores in your primary market, it proves that the consumer is resonating with the actual product.
Bracken Darrell actually explicitly stated this on the call. He said, quote, "This is where the trends start for Vans. The alternative channel is wholesale, which means selling massive bulk orders of shoes to department stores or specialty skate shops. And wholesale is fundamentally a lagging indicator."
Precisely. Wholesale buyers are incredibly risk-averse.
Because they're the ones holding the bag if it doesn't sell?
Exactly. They are allocating millions of dollars of open-to-buy budget months in advance. They base their purchasing decisions on historical sell-through data. If Vans has been cold for 3 years, a wholesale buyer at a major department store is not going to suddenly triple their order just because Vans launched a cool new marketing campaign.
They need proof.
They need mathematical proof that the brand is hot again before they commit capital.
I think the best way to visualize this dynamic for the listener is to think of Vans as a classic rock band trying to mount a comeback.
Okay, I like this.
You were the biggest band in the world 5 years ago, but your last 2 albums flopped, and the cultural conversation just moved on. You can't just announce a 100-city global stadium tour. The stadium promoters who represent the wholesale buyers in this analogy, they won't book you.
They don't want to take the financial risk of an empty arena.
Exactly. Because they have no data proving anyone still cares about your music.
That is a perfect structural analogy. So what is the operational strategy for the band?
You have to go play the small, intimate clubs. Those clubs are your DTC channel, your e-commerce site, and your own retail stores. You play the new material directly for your most hardcore, loyal fans. You control the lighting, the ticketing, the entire experience.
And if it works.
If those diehard fans show up, if they buy the merchandise, if they line up around the block and post about it incessantly on social media, you start generating undeniable localized heat. And once the stadium promoters see the physical lines outside those small clubs, then they pick up the phone and book the arena tour. The wholesale orders follow the DTC heat.
And management is utilizing this exact logic to signal to the market. They are saying, look at the America's DTC number. The clubs are packed again. The fans are buying the new material. The stadium bookings are inevitably going to follow in the back half of the year.
But the real question is how they are packing those clubs. It is one thing to say you want to generate brand heat. It is entirely another to execute it operationally. And this is where the COO, Abhishek Dalmia, laid out an operational shift that completely changes the risk profile of the business.
The speed to market initiative.
Yes, the speed to market initiative.
The structural changes to their supply chain are the most impressive engineering feat discussed on this call. To understand how radical this is, you have to understand the traditional go-to-market calendar in the global footwear industry. It is a monolithic, archaic process.
Let's break that traditional 18-month cycle down because it's crazy. In a normal legacy apparel company, if a designer has an idea for a shoe today, they drop a brief. Then they source the raw materials, which takes months. They build physical samples and fly them back and forth across the Pacific. Then they hold these massive internal line reviews where executives argue about colorways.
Which eats up more months.
Yeah. Then the sales teams take those samples and spend months pitching them to wholesale buyers. Once the orders are finally collected, they book manufacturing capacity in factories in Asia. The shoes are produced, loaded onto massive container ships, spend weeks in the ocean, get unloaded at the port of LA, trucked to a distribution center, and finally shipped to a store. That entire process takes 18 months.
Which is an absolute eternity in the modern cultural landscape. If a micro trend erupts on TikTok today, and it takes an organization 18 months to physically put a shoe on a shelf that addresses that trend, the trend is dead and buried.
You missed the boat. Literally.
You arrive at the party a year after everyone has gone home, and you are left with warehouses full of inventory that nobody wants.
But Dalmia detailed how Vans violently disrupted this cycle. They identified a popular silhouette originally slated for the fall 2026 season, and they pulled it forward to deliver in less than 6 months. And more impressively, they executed a localized product chase on a specific style from design brief to retail shelf in exactly 77 days.
From 18 months down to 77 days.
It's almost unbelievable.
Moving to a 77-day cycle requires ripping up the foundational architecture of how you source and build products. They didn't just ask the boats to sail faster, they achieved this by fundamentally changing vendor relations. Well, instead of sourcing new fabrics from scratch every time, they utilize a pre-approved materials library. They write incredibly sharp, data-backed design briefs. They likely utilize 3D digital sampling to bypass the physical prototyping phase, and they reserve flexible capacity with their manufacturing partners ahead of time. Dalmia referred to this posture as operating with creative confidence.
The financial implications of this speed are staggering. If you can chase a trend in 77 days, you completely change your cash conversion cycle. You aren't tying up hundreds of millions of dollars in working capital building inventory for a season that is a year and a half away.
Right, you're not guessing anymore.
You can produce a small batch, test it in your DTC clubs, read the real-time analytics on how the consumer is reacting, and then make an immediate algorithmic decision on whether to scale it up into mass production, tweak the design, or just kill the project entirely before you lose money.
It shifts the business model from predictive guessing to reactive agility. And the physical manifestation of this agility is undeniable. Brack and Darrell talked about a recent drop of a pearlized shoe. Because they constrained the supply and hit the market exactly when the trend was cresting, they had physical lines forming outside of their retail stores.
And he noted, and you could hear the mix of corporate sheepishness and obvious pride in his voice, that there were actual fights breaking out outside a couple of stores over the inventory.
Yeah, actual fights.
He literally said on the call, "We're not proud of the fights."
But let's be honest, if you are a brand manager who has spent 3 years watching your brand lose relevance secretly, you love the fights.
Oh, for sure.
The fights are the ultimate validation of your strategy.
Fights prove scarcity, they prove emotional resonance, they prove the brand heat is back. Vans is currently executing a strategy of creating highly limited, high-heat collaborations at the top of the funnel, and then systematically cascading those specific design attributes down into their more widely available, affordable commercial styles. And they're backing it up with a totally different marketing approach, too.
Exactly. Historically, Vans marketing was hyper-focused almost exclusively on hardcore skateboarders. Now, they are broadening the aperture to encompass a wider, more inclusive California lifestyle aesthetic. And crucially, they are tying their marketing dollars directly to specific product silhouettes to drive measurable conversion rather than just, abstract brand building.
Okay, so the product engine is finally revving. The supply chain is operating at startup speed, the clubs are packed, and the fans are fighting over the merchandise. That is a phenomenal narrative.
It's a great story.
But generating cultural heat means absolutely nothing to a shareholder if the unit economics of the business are broken.
Very true.
You can sell 10 million pairs of sneakers, but if your manufacturing, freight, and operating costs are out of control, you are just incinerating capital at a faster rate. So we have to look at how this top-line momentum is actually flowing through the income statement. Let's look at the margins.
This is where the narrative transitions from cultural theory to hard quantitative finance. And from an operational perspective, the single most impressive metric in this entire 2026 earnings report is the massive expansion in their gross margins.
Break those margin numbers down for us.
VFC expanded their overall gross margins by 360 basis points, finishing the fiscal year at a very healthy 55.2%.
Wow. Moving a global legacy conglomerate's gross margin by 3.6 percentage points in a 12-month window is a Herculean task. It implies a massive shift in how they are monetizing their product. But, we have to separate the accounting maneuvers from the actual operational efficiencies.
Right, the math versus the reality.
Exactly. How much of that 300 census point expansion is real and how much is just portfolio math?
It is a critical distinction. About 100 basis points of that improvement was purely mathematical, resulting from the divestiture of the Dickies brand.
Oh.
Yeah, Dickies historically operates as a workwear brand with structurally lower gross margins than premium outerwear or streetwear. When you amputate a lower margin asset from the portfolio, the blended average of the remaining brands naturally rises.
Right. But that still leaves 260 basis points of pure, organic, operational gross margin improvement. That means that across the board, VFC is manufacturing products more efficiently, selling them at higher initial markups, or losing less money to discount bins. How are they physically executing that margin expansion?
Management highlighted 3 primary levers driving this. First, a highly intentional mix shift toward higher margin products and channels, specifically the growth in DTC we discussed earlier. Second, targeted surgical pricing actions where brand strength allowed for it.
And the third?
The third lever is the most technologically compelling: the deployment of artificial intelligence to optimize their markdown strategies.
This is where the intersection of retail and tech gets incredibly fascinating. Let's talk about the mechanics of AI markdowns. Because historically, if a retailer had too much inventory of a specific winter jacket as spring approached, they would deploy a blunt force strategy.
They just slash prices.
Yeah, they would put a massive red banner across their entire website saying 30% off all outerwear.
Which is incredibly destructive to brand equity and margin. It trains the consumer to wait for the sale, and it unnecessarily sacrifices margin in regions where the product might still be selling perfectly well at full price.
Exactly. But what VAC has done, specifically rolling it out first across the North Face and Timberland Americas, is deploy localized algorithmic pricing. The AI engine ingests real-time store-level sell-through data. It models the price elasticity of every single SKU in every single location.
So it's looking at a jacket in Denver versus Miami.
Yes. So if a specific fleece jacket is selling briskly in Denver, the algorithm keeps it at full price. But if that exact same jacket is stalling on the shelves in Miami, the algorithm dynamically applies a hyper-localized discount just deep enough to clear the inventory without sacrificing a single dollar of unnecessary margin.
It is precision margin management. And the compounding effect of this technology is that VFC ended the year with significantly less distressed inventory.
Because everything is moving faster and priced smarter.
Exactly. When your supply chain is moving in 77 days instead of 18 months, you aren't over-ordering. When your AI is pricing dynamically, you aren't accumulating dead stock. You avoid the catastrophic scenario of having to dump millions of units to off-price liquidators at pennies on the dollar, which is what destroys gross margins in the retail sector.
So the top half of the income statement is optimized. Let's look at the operating expenses, the SG&A. The cost of actually keeping the lights on, paying the staff, and running the logistics network. They announced they removed $225 million in structural costs from the business.
That's a huge number.
It is. Now, as an analyst, whenever I hear a turnaround CEO boast about slashing hundreds of millions in operating expenses, my immediate instinct is skepticism. It is very easy to make a quarterly earnings report look good by firing your design team, halting your marketing spend, and deferring maintenance on your systems.
But you're just cannibalizing the future.
You are essentially eating your seed corn. You cannot cost cut your way to cultural relevance. So the question is, did VFC cut the fat? Or did they cut the muscle?
It is the ultimate trap of corporate restructurings. But the details provided by the COO suggest a highly disciplined structural approach to these cuts. They did not execute indiscriminate across-the-board percentage cuts. They targeted redundant infrastructure.
Like what?
For instance, they executed a massive consolidation of their distribution center footprint. They optimized the balance between their own logistics facilities and third-party logistics providers to create a more variable, cost-efficient network.
They also talked about modernizing their commerce platform. They retired legacy tech debt and transitioned to a more agile software stack that simultaneously elevates the consumer experience while structurally lowering the ongoing maintenance costs. That is a true operational win, building a better website that costs less money to run.
And addressing your concern about cutting the muscle, they explicitly stated that while they were removing $225 million in back-end overhead, they actually increased their financial investments in product development and consumer-facing marketing.
So they reallocated the funds.
Yeah, they ruthlessly shifted their marketing budgets away from bloated agency overhead and redirected it into working media dollars that actually reach the consumer's screen and drive direct conversion.
Which perfectly transitions us to the balance sheet. Because all of these operational efficiencies, the margin expansion, the SG&A cuts ultimately serve one master in a turnaround scenario: debt. Debt is the grim reaper of corporate strategy.
It really is.
It restricts your options, it dictates your timelines, and it eats your cash flow through interest expense.
And VFC was highly levered. But over the course of the fiscal year, they managed to pay down $800 million in net debt.
$800 million.
Yeah. They reduced their leverage ratio, which is the ratio of their total debt to their earnings from a very precarious 5.1 times down to 3.1 times.
Dropping 2 full turns of leverage in 24 months is a massive relief valve, and their stated target is to drive that ratio below 2.5 times. When you reduce leverage in a high interest rate environment, you fundamentally alter the cash dynamics of the business. You aren't just working to pay the interest on your loans, you start generating excess capital that management can actually deploy offensively.
We saw the immediate proof of that optionality in the free cash flow metrics. The CFO reported that normalized free cash flow, excluding a one-time $100 million benefit from terminating a pension plan, was a robust $405 million.
That is $405 million of real, unencumbered cash entering the corporate treasury.
And because they have secured the balance sheet, they announced they're increasing their capital expenditure, their CapEx, by $100 million for the upcoming year.
That CapEx number is the ultimate proof that this isn't just a defensive cost-cutting exercise anymore. You don't authorize a $100 million increase in capital spending to build new full-price Timberland retail stores unless you possess deep data-backed confidence in the underlying unit economics of the brand.
Exactly.
Management has clearly optimized the internal machinery of VFC. They have the supply chain humming, the AI pricing working, and the debt shrinking. But corporate machinery doesn't operate in a vacuum. It operates in a highly volatile global economy.
Which brings us to the macroeconomic headwinds. Regardless of how perfectly you tune the engine, you still have to fly the plane through external turbulence. The leadership team spent a significant portion of the call transparently outlining the non-company specific risks that threaten their trajectory.
Let's examine these risks, starting with geopolitics. They specifically called out the ongoing conflict in the Middle East. Now, to be absolutely clear to you listening, we are analyzing this strictly through the cold lens of supply chain logistics and corporate finance.
Right. We are not engaging in the political or ethical dimensions of global conflict.
Exactly. But from an operational standpoint, how does a geopolitical crisis halfway around the world actively hit the balance sheet of an apparel company headquartered in Colorado?
Geopolitical instability creates massive friction in global supply chains, primarily through the disruption of major shipping lanes like the Red Sea. When ocean freight has to reroute around the Cape of Good Hope, transit times increase by weeks, which ties up working capital and inventory on the water, and freight rates skyrocket.
And it hits consumer confidence, too.
Yeah. Additionally, regional instability actively dampens local consumer sentiment and retail traffic. The CFO quantified this risk, stating they expect the ongoing situation in the Middle East to negatively impact global revenue by roughly 100 basis points.
That's a full 1% hit.
Right. Furthermore, they highlighted a broader, generalized macroeconomic weakness across the entire EME region, Europe, the Middle East, and Africa.
Then there is the ever-present threat of trade policy, tariffs. They discussed a potential step up in tariffs set to take effect mid-July following the conclusion of Section 301 investigations. If enacted as proposed, this policy change could hit their gross margins by a staggering $70 to $80 million in the back half of the year.
That's a massive number.
Losing $80 million purely to a tax policy change is a heavy blow to any turnaround narrative. And finally, they cited the volatility of global oil prices.
Oil is a dual threat variable for a company like VFC. First, it dictates the fuel surcharges for the massive logistics network required to move millions of pairs of shoes across oceans and highways. Second, oil is the foundational raw material for the synthetic petroleum-based fabrics like polyester and nylon that dominate the outdoor apparel industry.
Now, I always have a slightly cynical reaction when management teams spend too much time listing external macro headwinds on an earnings call.
They're building in excuses.
Exactly. It often feels like they are preemptively building a get-out-of-jail-free card. If they miss their margin targets next year, they can point to the slide deck and say, well, we executed perfectly, but the tariffs and the oil prices defeated us. How much of this is excuse building versus legitimate, unavoidable operational turbulence?
It is the job of an analyst to maintain that exact cynical perspective. However, what separates excuse building from prudent management is the presence of a concrete mitigation strategy. The COO did not just list the headwinds. He detailed the operational architecture they have built to fight them.
So what's the plan?
To combat volatile oil and freight costs, VFC is heavily leveraging their massive global carrier scale to negotiate preferential, long-term contracted rates, insulating themselves from spot market spikes. To fight raw material inflation, they are utilizing a centralized VFC materials library.
The materials library concept is brilliant from a procurement standpoint. Historically, the Vans design team might order a specific black synthetic fabric from vendor A, while the Timberland team orders a nearly identical black fabric from vendor B.
Which is incredibly inefficient.
Right. By centralizing the materials architecture, they pool the entire purchasing power of the global conglomerate. They go to a single vendor with a massive consolidated volume order, which drives the unit cost down significantly and protects their gross margins.
Exactly, yeah. And regarding the $80 million tariff threat, they have not been sitting idle. Management stated they have spent the past year aggressively auditing and shifting their global sourcing footprint.
Moving production out of the way.
Yeah, they are actively migrating manufacturing volume out of high tariff origins and into more favorable trade lanes. Furthermore, they are engaging in intense negotiations with their vendor base to share the burden of any unavoidable cost increases. They express deep confidence that through this operational agility, they can mitigate almost the entirety of that $70 to $80 million tariff impact in fiscal 27.
They aren't just bracing for the storm, they're actively rerouting the ship. Which brings us to the ultimate synthesis of this call. Factoring in the explosive growth of the North Face, the systemic operational overhaul at Vans, the localized AI pricing models, and the looming geopolitical tariffs. What is management actually promising the market for the year ahead? And how should an investor interpret those promises? Let's dive into the forward guidance.
The most bullish signal management said on this call wasn't a specific number. It was the structural decision to reinstate annual forward guidance.
Because they hadn't been giving it, right?
Over the past few years, VFC had suspended giving yearly forecasts because their internal visibility was so compromised by bloated inventory and chaotic supply chains that they literally could not predict their own performance.
Wow.
The act of reinstating annual guidance is management publicly declaring that they have regained absolute control over this steering wheel.
So what does the dashboard look like for fiscal year 27? They are projecting 1% to 2% revenue growth in constant dollars. Now, we should note that includes a slight mathematical bump because fiscal 27 happens to be a 53-week reporting year. But even adjusted, it signifies a commitment to sustained top-line expansion. However, they did offer a very specific warning about the immediate timeline. Quarter one is going to look rough.
They project Q1 revenue to be down in the low single digits, but they spent significant time clarifying the mechanics of that drop. It is largely driven by wholesale timing shifts.
Explain that timing shift.
Because their supply chain is operating so much faster now, some of the inventory demand from wholesale partners that was historically fulfilled in Q1 was actually pulled forward and shipped in Q4 of the prior year.
Right. The CFO walked analysts through the math, showing that if you normalize for that specific timing shift and look at the 2 quarters combined, the underlying growth trajectory is stable. The takeaway there is clear. Do not panic and sell the stock when the Q1 headline revenue drops, because the drop is an artifact of supply chain efficiency, not a collapse in consumer demand.
Looking further out at profitability, they are targeting a full-year operating margin of 8% for fiscal 27. But the metric that dominated the Q&A session was their medium-term target for fiscal 2028. They are aiming for an exit run rate of a 10% operating margin.
We need to definitively translate that specific piece of Wall Street jargon because several analysts on the call seem to misinterpret it. What is the functional difference between an annual margin and an exit run rate margin?
Brackendale had to be explicitly clear on this point. VFC is not promising that the entirety of fiscal year 2028 will average a 10% operating margin. What they are committing to is that by the end of the 4th quarter of fiscal 28, the company will have executed enough structural efficiencies that they will be operating at a velocity, a run rate, that equates to 10% on an annualized basis.
It's the difference between your average speed over a whole road trip versus the speed your speedometer reads exactly as you cross the finish line.
Great way to put it.
They are promising that as they cross into fiscal 2029, the machine will be reliably churning out 10% operating margins. So, synthesizing all of this data, let's lay out the ultimate bull and bear cases for the listener who is evaluating VFC today.
The bull thesis is anchored in undeniable operational reality. The balance sheet recovery is not theoretical. Paying down $800 million in debt is hard math. The North Face has cemented itself as an elite global powerhouse capable of commanding premium pricing across multiple categories.
And the internal machinery is fixed.
Right. The internal machinery of the conglomerate has been fundamentally modernized. The ability to chase product trends in 77 days and the deployment of AI to protect gross margins proves they are operating with a level of sophistication that simply did not exist 2 years ago.
And the crowning jewel of the bull case is that 5% growth in Vans America's DTC. That is the exact green shoot the market has been desperately searching for. If you believe the logic that DTC is the leading indicator, if you believe the clubs are packed and the fans are fighting over the merchandise, then the massive, high-margin wholesale arena tour is inevitably coming in the second half of the year.
Conversely, the bear thesis requires acknowledging the fragility of the macro environment and the friction of the turnaround timeline.
It's not all sunshine.
Right. Q1 is going to look negative on paper, which always tests shareholder patience. The European market remains a significant drag on global performance. And most importantly, while the DTC green shoots for Vans are deeply encouraging, the financial reality is that everything still hinges on those massive, risk-averse wholesale buyers actually writing the big purchase orders for the back half of the year.
Brack and Darrell mentioned that wholesale buyers were very optimistic at a recent brand cookout event, but optimism at a barbecue doesn't pay the interest expense on corporate debt.
No, it does not.
Signed purchase orders do. So here is the definitive, actionable takeaway for you as a listener and a potential investor. You can ignore the noise around the Q1 revenue dip. The supply chain timing map explains it. The single most vital metric you need to monitor the absolute canary in the coal mine for the entirety of VF Corporation is the Vans wholesale order book as we enter the second half of the year.
If those stadium promoters start booking the arena tour, this turnaround is mathematically real, and the leverage reduction will supercharge the equity.
But if the wholesale buyers hesitate, the enterprise is still vulnerable.
It is the ultimate litmus test for whether cultural heat can be successfully translated back into institutional scale.
When you step back and look at the holistic 18-month journey of VF Corporation, it is genuinely remarkable. We have watched a bloated, debt-heavy legacy conglomerate, which was fundamentally struggling to understand why youth culture had abandoned its flagship skate brand, ruthlessly tear down its own operations.
They've done the hard work.
They have restructured their balance sheet, they have violently accelerated their supply chain, and they are beginning to recapture that elusive, highly profitable cultural heat. They have definitively shifted from a posture of corporate survival to a posture of strategic offense.
And the early quantitative results of that offensive strategy are deeply compelling for the long-term health of the portfolio.
But I want to leave you with a final provocative thought to mull over. We began this deep dive discussing the inherent tension between the rigid precision of corporate engineering and the unpredictable, messy reality of cultural relevance.
The math versus the magic.
Exactly. We have seen VFC successfully deploy artificial intelligence to surgically manage localized markdown pricing. We have seen them algorithmically hack a legacy global supply chain to compress a product creation cycle from a sluggish 18 months down to a hyper-reactive 77 days. That is an absolute masterclass in retail engineering. But we are operating in an era of hyper-fast fashion.
Moving at light speed.
We live in a world dominated by TikTok micro trends that can organically explode and completely burn out within a 3-week window. Is 77 days, as incredibly fast as it is for a legacy company, actually fast enough to capture the modern consumer?
That's the million-dollar question.
Can a 125-year-old corporate conglomerate truly use algorithms and supply chain hacks to artificially manufacture authentic youth culture? Or will the soul of a brand like Vans, the actual raw heat that makes a teenager want to wear the shoe, always require a level of unquantifiable, unpredictable chaos that simply cannot be programmed into a corporate spreadsheet?
Something to think about.
It is the ultimate existential question for the future of retail. Thank you for joining us on this deep dive.